Worried about a recession? Wondering if now is the right time to buy a home? Look, during the 2008 crash, home prices tanked 19%. But in 2001, they went up by 6.6%. Big difference, right? With economists predicting a 2025 recession and a Q1 GDP already turning negative, today I'm breaking down what really happens to mortgage rates and home prices when the economy slows down. As a licensed mortgage broker and homeowner myself, I help families each and every day navigate real estate decisions in uncertain economic times, including during market slowdowns and recessions. Now, these trends can completely shift how you approach buying a home this year. Okay, so let's cut through the hype and get into what the data actually shows. Now, most people think recession equals housing crash, and that's a myth. In 5 of the last 6 recessions, mortgage rates actually dropped. Why? Because when the economy slows down, the Fed steps in and lowers rates to get things moving again. That makes borrowing cheaper, including mortgages. Now, yes, 2008 was bad, but this wasn't just a recession, it was a housing meltdown. Different story. Most recessions aren't caused by housing, so they don't hammer home prices the same way. For example, in 1980, rates hit 18.5%. It's crazy high. In 2020, during the COVID recession, they dropped under 3%. That's pretty nice. But it was the same situation. It was a recession. And totally different outcomes. Now, let's look at home prices. In 1990, prices fell 1.9%. 2001, prices rose 6.6%. 1980, up 4.1%. If the recession isn't driven by housing, prices usually stay flat or even go up. In 2025, it looks like it's driven by inflation and high rates, not a housing bubble. Now, charts show that when GDP dips, mortgage rates usually follow. Again, unless housing is the problem. So let's talk specifics. During 2001, rates dropped from 7.2 to 5.8. 1990, from 10.3 to 8.5. And are you waiting to buy until rates come down? Historically, that move has paid off. But if you're waiting for a 2008 style crash, don't hold your breath. Before we get into the next point, my name is Emmett Dempsey. I'm a mortgage broker and owner of Treasure Coast Mortgage here in Port St. Lucie, Florida. Now, if you want to learn more about these recession numbers and more, go ahead and click the first link in my description for a free buyer's guide. I mean, if you're looking to buy a home this year, it's got some great information to help answer any questions you may have. Okay, with that out of the way, let's talk more about recessions and housing prices. Okay, here's the truth to home prices in recessions. In 3 of the last 6 recessions, home prices increased. That shocks people, but it's real. Why? Because housing is local. Now national headlines might scream housing crash, but if you were to house hunting in Dallas in 2008, you probably wondered what the fuss was all about. I mean, some Texas markets dropped only 8%, while Vegas cratered 62%. Take East Austin. Home values barely budged in 2008, thanks to strong job growth and tight inventory. And tight inventory is key. I mean, right now, many markets have just 3 or 4 months of supply. A balanced market, remember, is 6 months or more. I mean, this shortage helps support prices even during slowdowns. Now, each region reacts differently. In 2001, the Northeast saw gains. The West dipped slightly. In 1990, the South stayed flat. The Midwest saw small losses. But today's market is built on stricter lending standards, believe me, and massive home equity. That's a solid foundation. It's not like a house of cards like the 2008 was. So no, a recession doesn't mean you'll get a house at 50% off, no matter what the housing crash bros say. Warren Buffett has a famous quote, "Be greedy when others are fearful." But does that apply to buying real estate in a recession? I mean, the short answer is it depends. I mean, during downturns, competition drops and sellers get more flexible. When you're not battling 10 offers, and you might be the only one. But lending tightens up. In 2008, down payments jumped from 5% to 20% for many buyers. I mean, that's a huge difference. $20,000 versus $80,000 on a $400,000 home. And the data's clear. I mean, buyers who waited 12 to 18 months into a recession before buying saw 5-year returns nearly 30% higher than average. And those who bought early often sat underwater for a few years. Also, property type matters. I mean, single-family homes hold up value better than condos. In cities with diverse economies like Dallas and Denver, we saw far less damage than one industry towns. I mean, do you have cash reserves? I mean, that's huge. I mean, during recessions, lenders might want 6 to 12 months of reserves instead of the usual 2 to 3. I mean, guidelines change all the time, guys, so you never know. The bottom line is don't rush. You're wait for signs of stabilization. Then look for quality homes and strong locations. Even during the worst housing crash in modern history, 2008, mortgage rates dropped. 30-year fix went from 6.8 to 5.1, and that surprises a lot of people. But here's what most folks don't know. The Fed didn't just cut short-term interest rates. They also bought billions in mortgage-backed securities, or MBS. And that move directly pushed mortgage rates lower by flooding the market with demand for these loans. It's a big reason buyers with stable income were still able to score low rates, even during the chaos. And the pattern shows up in other recessions too. In 2001, the dot-com bust, rates fell 1.4% from 7.2 to 5.8. In 91, rates dropped from 10.3 to 8.5. In 2020 COVID recession, rates hit record lows, falling under 3%. That's pretty nice. In every one of these, the Fed stepped in to lower the federal funds rate, and in some cases, like 2008 and 2020, they also aggressively bought MBS. Think of it like this. When the economy stalls, the Fed throws fuel on the fire to get it going again. But there's one wild card: inflation. Inflation stays high during recession, like in the 70s, the Fed might be more hesitant to cut aggressively or buy MBS, and that could limit how far mortgage rates fall. Still, over the past 50 years, mortgage rates fell by an average of 1.5% during recessions. So if a 2025 recession hits and inflation is under control, there's a good chance we'll see rates move lower again. Let's hope so. So if you're hoping for lower mortgage rates, history is on your side. Just don't expect to perfectly time the bottom. The smarter play, you need to be ready and act when the window opens. So what does the data really show? Most recessions don't crash home prices, but rates, that's where the real opportunity is if you know how to navigate it. Now, you might think you're ready to buy a home, but are you really? Most buyers overlook key costs that never show up in the listing price. And those surprises, they can wreck your monthly budget fast. And if you watch this video here, find out more about these costs. They'll show you the stuff nobody tells you until it's too late. And if you want no fluff, real-world advice from someone in the trenches every day like me, go ahead and hit the subscribe button. I'm here each and every week helping you make smarter real estate moves without the noise. See you on the next one.